In a rapidly evolving cryptocurrency landscape, recent developments surrounding the U.S. Securities and Exchange Commission (SEC) and the ongoing legal battles faced by Ripple, the company behind the XRP cryptocurrency, have ignited renewed interest among investors. The SEC's regulatory approach to the crypto sector has been a point of contention, particularly since the agency filed a lawsuit against Ripple in 2020 alleging that the company violated securities laws by selling XRP to investors. This legal struggle, which saw a partial resolution in August 2024, is now poised for further changes as a shift in political climate may favor a more lenient regulatory environment. Under the new administration of Donald Trump, who has shown a proclivity for supporting the crypto industry, there is speculation that the SEC could adopt a friendlier stance. Just last week, the SEC agreed to pause its lawsuit against Binance, a major cryptocurrency exchange, leading to speculation that a similar pause could soon apply to Ripple's case. Observers note that a favorable outcome for Ripple could enhance operational freedom for the company and drive broader adoption of XRP, which is designed to facilitate faster and cheaper international money transfers. Ripple's payment network, known as RippleNet, allows banks to settle transactions directly regardless of their underlying infrastructure, thus promising to streamline cross-border payments. XRP serves as a bridge currency in this system, enabling banks to bypass traditional currency exchange fees. However, the SEC contends that XRP should be classified as a security, which would subject Ripple to stringent regulatory requirements. Despite the potential for a more favorable regulatory environment, analysts caution against overzealous optimism regarding XRP's price trajectory. The cryptocurrency remains highly speculative, with its value often determined by market sentiment rather than intrinsic demand. While a positive resolution of Ripple's legal challenges could bolster investor confidence, the fact remains that banks are not required to use XRP to benefit from Ripple's technology. This reality has contributed to XRP's struggle to regain its 2018 peak, highlighting the precarious nature of its market position. As the crypto landscape continues to develop, the relationship between regulation and innovation will be critical to watch. The SEC's evolving approach under new leadership, including the appointment of Paul Atkins as chairman, may signal a broader shift towards accommodating the industry's growth while ensuring investor protection. Meanwhile, the cryptocurrency sector is not without its challenges. Recent news from Argentina highlights the caution with which some governments and financial advisors approach crypto investments. President Javier Milei's promotion of a new crypto token intended to support local businesses was met with skepticism and fears of potential scams, leading to its swift retraction. This incident underscores the volatility and the speculative nature of the crypto market, even as it garners interest from investors looking for alternatives to traditional assets. In conclusion, the future of XRP and the broader crypto market hinges on the interplay of regulatory developments, market demand, and investor sentiment. As regulatory frameworks become clearer and the industry matures, the potential for cryptocurrencies to serve as a viable alternative to traditional financial systems may come to fruition. Investors will need to navigate this landscape carefully, balancing the allure of potential gains with the inherent risks associated with digital currencies. The coming months will likely reveal whether the SEC's changing stance translates into tangible benefits for Ripple and other crypto entities, or whether skepticism continues to dominate the narrative. In the ever-evolving world of cryptocurrency, recent developments suggest a resurgence of optimism among Bitcoin miners and investors alike, sparking discussions about the potential trajectory of the market. As Bitcoin continues to grapple with market fluctuations, analysts are presenting contrasting perspectives that could shape the future of digital currencies. Michaël van de Poppe, a well-regarded cryptocurrency analyst, has articulated two possible scenarios for Bitcoin and altcoins in the coming months. He posits that Bitcoin could peak in late 2025, followed by an altcoin surge in early 2026, reflecting the cyclical nature of the market influenced by Bitcoin halving events. Alternatively, van de Poppe anticipates a more dramatic rally for cryptocurrencies fueled by rising equity prices and favorable policies from President Donald Trump. He noted the S&P is going to copy-paste the last 4 years of the dot-com bubble with 4 years of 20% returns or more, suggesting that Bitcoin could reach unprecedented heights, potentially hitting the $1 million mark, while altcoins might experience valuations that defy rationality. Despite this bullish outlook, Poppe cautions that a significant market correction could follow such euphoric highs, especially as macroeconomic conditions shift. This cycle might have started late for altcoins, marking the longest bear market in their history, he added, hinting at the fragile balance between optimism and reality in the cryptocurrency landscape. On the ground, Bitcoin's price has remained volatile, trading around $97,641.16 as of the latest reports. This volatility is underscored by Justin Bennett, another prominent analyst, who has pointed to tether dominance as a crucial indicator for Bitcoin's immediate future. He explained that the tether dominance chart USDT.D has been holding above recent highs, which traditionally signals a bearish trend for Bitcoin. Bennett stated, if USDT.D drops back within the range on the high timeframes, then we have a bullish crypto market. If it can't, expect sideways to lower for BTC, ETH, etc. His insights suggest that traders are increasingly favoring stablecoins over more volatile assets, indicating a cautious sentiment in the market. Moreover, Arthur Hayes, co-founder of BitMEX, has introduced a fascinating perspective on market sentiment. He speculated that a shift in public perception could see a new Trump coin outpacing Bitcoin, reflecting how political narratives and leadership can influence cryptocurrency dynamics. Amid these varied viewpoints, the cryptocurrency market is showing signs of life, with Bitcoin, Ethereum, XRP, and Dogecoin experiencing gains recently. Speculation is growing around a potential approval for a Dogecoin ETF in 2025, with betting markets indicating a 74% chance, further fueling optimism in the sector. As Bitcoin miners express hope that the market cycle is not yet over, the interplay of various factors, from macroeconomic trends to political influences, will continue to shape the landscape of digital currencies. With analysts divided on the potential for a market surge followed by a correction, the next few months will be critical for Bitcoin and its altcoin counterparts. Investors and enthusiasts alike will be watching closely as the cryptocurrency market stands at a crossroads, poised between the promise of a bullish era and the realities of economic fluctuations. As we look ahead, the emphasis remains on adaptability and vigilance in navigating this rapidly changing environment. In the ever-evolving landscape of cryptocurrency, the emergence of political memecoins has sparked both intrigue and skepticism. Among these, Trump, the memecoin linked to former President Donald Trump, has garnered attention not just for its whimsical nature but for its potential implications on the broader crypto market. Arthur Hayes, the co-founder of BitMEX and a notable figure in the cryptocurrency community, recently articulated a compelling argument that positions Trump as a significant predictor for Bitcoin's price movements, a tool for campaign fundraising, and even a substitute for traditional polling mechanisms. Hayes' perspective is rooted in the belief that $TRUMP's unique origin as a political token offers insights into real public sentiment, free from the biases of conventional media and social pressures. Trump, in one masterstroke, just enacted campaign finance reform, and I don't think he even knows it, Hayes stated, highlighting the innovative intersection of politics and finance that Trump represents. By allowing supporters to invest in a token that reflects their political allegiance, Hayes argues that it creates a financial incentive for political engagement, potentially reshaping how campaigns are funded. The practical implications of this are profound. According to Hayes, political memecoins like Trump provide a zero-knowledge proof of political popularity, enabling individuals to privately express their support without fear of social stigma. This newfound anonymity could offer politicians a more accurate gauge of their public standing, a stark departure from traditional polling methods that often face criticism for their lack of nuance and potential biases. Moreover, Hayes posits that $TRUMP's market performance could serve as an indicator for Bitcoin's movements, suggesting a symbiotic relationship between the two. If insiders believe an upcoming policy will positively impact crypto, Trump will surge before the news is announced, then Bitcoin will follow, he explained. This assertion underscores the interconnectedness of political developments and cryptocurrency markets, where sentiment can shift rapidly based on perceived political actions. Recent trading activity has validated some of Hayes' claims. Following a tumultuous period where $TRUMP's value plummeted from $73 to under $15, the token recently rebounded with a stunning 40% surge, settling at around $21. The increase in trading volume, which soared past $7.1 billion, signals a renewed interest from traders looking to capitalize on the volatility inherent in meme-based cryptocurrencies. This revival coincides with broader movements in the crypto market, where Bitcoin remains strong, trading at approximately $97,420, and notable altcoins like XRP and Dogecoin also exhibit significant gains. As the market continues to react to socio-political developments, the appetite for speculative investments in political memecoins could further intensify. Analysts are closely monitoring the developments surrounding Trump, particularly as the crypto landscape navigates regulatory shifts and potential endorsements from influential political figures. The intersection of politics and cryptocurrency promises to be a fertile ground for investment and speculation, with Trump at the forefront of this emerging trend. Looking ahead, the potential for Trump to influence Bitcoin's price serves as a reminder of the unpredictable nature of digital assets. As political climates shift and public sentiment evolves, the dynamics of cryptocurrency markets will likely continue to intertwine with the political landscape, making it crucial for investors to remain vigilant and informed. The future of political memecoins like Trump may well redefine how we understand both finance and governance in the digital age, ushering in new models of engagement between citizens and their representatives. In recent months, Ethereum has faced a notable decline in staking interest, prompting questions about the cryptocurrency's future viability amidst intensifying competition from Bitcoin and Solana. As of February 2025, Ethereum's staking has seen a significant downturn from its peak in November 2024, raising concerns that investor enthusiasm may be waning. However, industry leaders are proposing innovative strategies, including staking-enabled exchange-traded funds (ETFs), which could reinvigorate institutional interest and cement Ethereum's standing in the crypto market. Ethereum's transition to a proof-of-stake model promised a new era of yield generation for holders, allowing them to earn returns on their investments. Yet the reality has been starkly different. Grayscale's Ethereum Trust ETH recently reported nearly $4 billion in outflows, making it the largest casualty among Ethereum investment vehicles. In contrast, competing products like those from BlackRock and Fidelity have attracted substantial inflows, highlighting a growing preference for more favorable fee structures and institutional backing. In a bid to reverse this trend, Grayscale has sought approval from the SEC to implement a rule change that would allow its Ethereum Trust and Ethereum Mini Trust to stake their Ether holdings through trusted providers while maintaining asset custody. This proposal, if approved, could enable these funds to generate additional ETH returns, thereby enhancing their attractiveness to investors. As noted in a memorandum from Jito Labs and Multicoin Capital submitted to the SEC, Crypto Task Force advocates argue that incorporating staking features into ETFs would not only benefit investors but also bolster the security of the networks in which these assets operate. Keen Gilbert, an institutional relations contributor at Lido DAO, recently indicated that staking-enabled ETFs could become a reality by the end of 2025. With Lido managing over $25 billion in staked assets. Gilbert emphasized the significant opportunity costs faced by institutional investors who currently lack access to yield-generating ETFs. We're seeing strong demand for solutions that combine the regulatory clarity of ETFs with the yield-generating capabilities of Ethereum staking, he explained. The potential introduction of these ETFs comes at a critical juncture for Ethereum, which has struggled to maintain its market share against the backdrop of Bitcoin's dominant digital gold narrative and Solana's rapid ascent. Ethereum's current price hovers around $2,700, while Bitcoin remains near $97,000. The challenges for Ethereum are compounded by the SEC's historical skepticism towards staking models, which it has deemed as potentially constituting unregistered securities offerings. However, the regulatory landscape may be shifting. Earlier this month, NYSE Arca filed a proposed rule change that seeks to enable Grayscale's Ethereum Trust to stake its holdings. This approach prioritizes a secure, custodial method of staking that could set a precedent for other ETF issuers. Additionally, Hong Kong's Securities and Futures Commission has shown openness to allowing staking in Ethereum ETFs, suggesting a potential pathway for regulatory acceptance in other jurisdictions. The implications of staking-enabled ETFs could be transformative for Ethereum's market dynamics. Current staking yields hover around 3% annually, an attractive proposition that institutional investors have been unable to access through traditional ETF structures. Brian Ruddick, a senior strategist at GSR, remarked, "It's about making Ethereum ETFs truly competitive with direct cryptocurrency holdings, potentially unlocking billions in institutional capital that's currently sitting on the sidelines." As discussions surrounding staking-enabled ETFs evolve, market participants are left to ponder the future of Ethereum in a competitive landscape. The pathway to regaining momentum will not only hinge on regulatory approval but also on Ethereum's ability to integrate its staking benefits into investment products that resonate with institutional investors. The timeline suggested by Litos Gilbert allows issuers to prepare robust custody and staking solutions, but only time will tell if such developments can effectively bridge the gap between traditional finance and the innovative potential of Ethereum. The cryptocurrency world is undoubtedly poised for change, and the introduction of staking-enabled ETFs could serve as a pivotal moment for Ethereum, possibly reigniting the interest of institutional investors and reshaping the future of crypto investment strategies. The cryptocurrency landscape is witnessing a seismic shift, with altcoins like Solana SOL emerging as formidable contenders against established players like Ethereum ETH. Recent developments have positioned Solana at the forefront of this transformation, raising questions about its potential to reshape the market dynamics and possibly deliver significant returns for investors in 2025. Solana's ascent has been notably marked by a surge in institutional interest, which has catalyzed its growth trajectory. The launch of a Solana-based tokenization platform by Taurus, supported by Deutsche Bank, signifies a pivotal moment for the ecosystem. This integration is not just a boost for Solana's credibility, it also enhances its utility in traditional finance by enabling secure custody and efficient management of digital assets. As institutional players increasingly seek reliable platforms for tokenization, Solana's capability to process thousands of transactions per second without congestion issues positions it as a prime candidate for further adoption. In the current market climate, Solana is setting its sights on significant price targets, with analysts forecasting potential rallies toward $225 and even $260. As of February 15, 2025, SOL is demonstrating robust performance, maintaining a critical support level around $190. Technical indicators suggest that if this momentum persists, SOL could easily breach the next resistance levels. The importance of the $190 level cannot be overstated, as it has consistently acted as a foundation for bullish trends in the past, noted a market analyst. This bullish sentiment is further reinforced by the growing ecosystem of decentralized finance DeFi applications and non-fungible token NFT marketplaces that are flocking to Solana, enhancing its appeal to both retail and institutional investors. Meanwhile, Ethereum continues to capture attention as a leading altcoin, primarily due to its robust institutional demand, with plans for Ethereum ETFs gaining momentum. Major firms like CBOE and 21 Shares are looking to incorporate staking into their offerings. This could attract a wave of institutional investment, solidifying Ethereum's status as the backbone of the blockchain ecosystem. Despite price fluctuations, Ethereum recently saw a decline of over 16.65% in a month. Its fundamentals remain strong, making it a reliable investment choice. Tron TRX, another player in the altcoin arena, is showcasing its strengths by dominating the stablecoin market with billions in daily USDT transfers. While the network faces scrutiny over regulatory concerns, its fast transaction speeds and low fees have kept it busy with on-chain activity. Tron's strategic partnerships aim to expand its ecosystem, underscoring its potential role as a cost-efficient layer for decentralized applications. Adding to this vibrant mix is the emergence of DTX Exchange, which has recently surged 540% in pre-sale, capturing the attention of investors. Its hybrid trading platform aims to unify cryptocurrency stocks, forex, and ETFs under one roof, creating substantial utility in a space often criticized for lacking tangible value. Analysts predict that DTX could see a tenfold increase post-launch, highlighting the demand for innovative solutions in the crowded crypto market. The trajectory for these altcoins is promising, yet fraught with volatility inherent in the cryptocurrency market. While the bullish signals are strong for Solana, Ethereum, and Tron, unexpected market shifts or regulatory developments could alter their paths. Nevertheless, the increasing institutional backing coupled with positive technical indicators suggests that Solana's objectives of reaching $225 and $260 are not just wishful thinking but rather attainable milestones. As we look toward the future, the cryptocurrency market is poised for further evolution, with Solana carving out its niche and Ethereum maintaining its dominance amidst institutional interest. The next few months will be critical. Investors and traders alike should remain vigilant as these altcoins navigate their way through a landscape ripe with opportunity and challenges. The developments of 2025 promise to be pivotal, and those who position themselves wisely may find themselves at the forefront of the next bullish wave.